I think there's, generally speaking, a shift upward in quality. You've had a focus on stronger balance sheet companies where there's more stable margins, the idea of a more durable business model. Those were, I think, most of the conversations we've been having with fund managers have been directed.
Understood. David, if you are patient capital, then if you are inclined to selectively buy this dip in tech, what do you go for?
Well, the number one variable in 2022 is about margins, profit margins. It's really less about the top line revenue. Would emphasize companies where there's high and stable gross margins. That's a kind of group of stocks that meet those criteria, are likely to outperform, have been outperforming, like that is likely to continue to be the case, number one. Number two, you really have to think about the profit value chain and the idea of higher interest rates. Now, the Goldman Sachs view is you've got 5 Fed hikes coming, and you have 10-year Treasury yields, and more importantly, real bond yields. Real Treasury yields are likely to be rising, and in that environment, the companies where there's longer duration are more vulnerable to continued downturns. And so the idea would be companies with high profit margins and also high growth, of course, that's within the tech sector, generally speaking. So those are 2 categories: high and stable gross margins, and companies where there's basically the business model is less dependent on rates to support the low rates to support the business.
If I'm reading you correctly here, David, it sounds like, over the past 2 years when companies have been talking about their future, they talk a lot about the supply side issues that they're grappling with during COVID. But maybe the demand side is something that we'll hear more of, given the fact that, consumers are hit by rising inflation. They're going to get hit also by rising interest rates. And also, a lot of people aren't going to be receiving the same level of government stimulus checks that they did over the past 2 years. Is that a correct reading?
Well, you can think about the business model and how many are customer-facing, if you will, consumer-facing versus enterprise-facing. Where's the business demand? The economy is slowing or decelerating here in the United States. There are issues on the consumer, although the savings rate is extremely high, and so there's still likely to be better economic growth, positive growth, if you will, for the balance of this year and really into next year. So we think about the business activity. It's really I'd say about margins and what are the other beneficiaries. We talk about some of the cost structure. Well, energy companies are benefiting from really significant increases in oil prices. The stocks have done well this year so far. Oil prices likely to move towards $100 a barrel. That's the Goldman Sachs view. Well, the energy companies will be strong beneficiaries on earnings, and the earnings forecasts we have are dramatically above consensus, likely to lead to positive earnings revisions. So there are other pockets. I know you're focusing on technology, but think about where there's other opportunity sets in the market. Tech is obviously a big component to the market. It's very important, growing a lot, but energy, healthcare stocks, cheapest they've been in 30 years on a relative basis. So there are other opportunity sets, related to the U.S. equity market, not just in tech.